Hey guys, welcome to Tradebooms YouTube channel. So today we'll be discussing about the stock market basics. So let's start. So this is our mind, and our mind should always be fitted with something new so it can develop. Regularly we are active, we are normal. Our mind is fixed to a particular work we are doing every day. But if we have a dynamic mind, it will always search for curiosity. It can generate sources that are passive and can make you different from others. And the things you develop will help you in future too. So knowledge is the most important thing. So try to learn something new and different every day. So today we'll be discussing about the stock market basics. Next 10 minutes can be super exciting. It can help you develop a new way to earn passively. So let's start. So stock exchanges. Stock exchanges is a place where companies get registered to allow their shares to be traded in public, to raise money from the public. So most popular stock exchanges in India are NSE and BSE. So what is NSE? NSE is a national stock exchange. It is a popular index of Nifty 50 with top 50 companies in it. Whereas BSE is Bombay Stock Exchange with an important index of Sensex comprising of top 30 companies. So what are index? Index are the parameter of the economic growth. Index reflect the performance of the top 50 or the 30 companies, and on the basis of that we can understand how the economy is growing. This is the NSE building and this is the BSE building. So now how to start? First of all, you have to open a demat account. Like for saving your money, you are opening a bank account. In the same way, saving and depositing your securities, we need to have a demat account. A demat account can be opened from so many brokers, the popular being Zerodha, Upstock, Angel Broking, Sharekhan, Carvey, etc. and so many are there. Capital, see a surplus as you have. This is your money, your hardcore earn money. So you have to decide how much capital you'll be bringing. My advice is to bring the money that you are saving. Means that's a part of your saving that you are keeping it unutilized. So let be invested in the market to give you some profit. Third important thing is mentality. Your mentality should be defined. You should know what type of investor you are. You may be short term or long term. That depends person to person. Patience is the most important factor too. See, company can't grow within one day or two. It needs time. It needs years to develop something and grow. So if you stick to a company, obviously it will grow and give you better returns. Ignore greediness. See, when people start earning from the stock market, they used to take risk. They want to earn as much as they can and as early. That should not be your path of working in the stock market. You have to be consistent, and book profits normally. You do not follow greediness. So we have two markets, primary market and the secondary market. See, we understand how to open a stock market demat account with different brokers for the retail investor. But how companies are listed in the stock market? This is the way. When a company newly listed in the market, it has to cross the IPO. IPO is initial public offering that a company has to do to get the feedback from the market that it is well established and people are interested for these companies to be listed. One important and major factor that when a company is going to list and raising money from the market, it has to open an IPO, and that IPO should be 90% subscribed. It resembles that the company has a high demand and people are interested in that market. So after having subscribed to 90% subscription, company will get listed, and then it will be shifted to the secondary market where people like us and institutions can buy, sell and hold those company share. Next is capital market. So our capital market is divided into MCX, equity and derivative. MCX is multi-commodity exchange. Here commodities are traded like dal, rice, grams. Okay. Equity. Equity has two part, cash delivery and intraday. In cash delivery, we are purchasing the share by giving its full amount and we are holding it. But in intraday, we are purchasing the shares and selling those shares in the same day. Derivatives. Derivative consists of futures and options. A derivative is a contract that derives its value from the underlying assets. So the value of it depends upon its underlying assets. In futures, there is a contract to exchange at a future date at a future price. Okay, it is too pricey and good for persons or institutions or companies that are dealing in currencies and have risk of high fluctuations demand. In options, we have call option, put option. A call option is the right to buy and a put option is the right to sell. In these two options, we have to identify if we are buying a call option means we are assuming that the market will go up, and in a put option we are assuming that the market will go down. So it is purely on the assumption basis what can be the next price level. Hope you understand this is a capital market concept. The more discussion and analysis can be done in our several other videos, and soon we'll be launching our stock market course, basic to advanced. So this is the starting point where we'll be learning all the basics thing. Okay, but why I need to invest? You need to invest to contribute to the growth of the company, because as much as you invest, it indirectly helps the company to increase its market value and its brand, and companies will be encouraged to work hard and benefit you in the form of capital gains, dividends, bonus, splits, right issue, so many things. So many things are there that a company can benefit you. Every day we are spending money in so many things, but they are not giving us back the money we invested. The stock market is a place where you invest and you can earn a good decent amount of profit if you are consistent and you are knowledgeable in what you are doing. You have a better analysis of it. So there are so many companies, which companies to select? For that basis, we have two analysis, fundamental analysis and the technical analysis. On that basis, we can understand how a company is performing, what's the price level, and when we can buy it or sell it. So in fundamental analysis, we have all these points like EPS. EPS is the earning per share. Earning per share shows the earning of the company after reducing all its expenses. That is the earning per share. What is the value that each share is getting out of the profit of the company? PE ratio. PE ratio defines the price to earning ratio, and it shows how much the stock is valued, how much price is the stock, and how much money we can offer for the stock. Past and future growth. We can see the past trend, how the company is performed, and the future expansion plans. Its face value. When a company is listed, it has to give to the market a price that is the base price. Most of the companies, it is rupees 10. Book value show how your assets is valued. Your assets, liabilities. It shows the net book value of your assets minus liabilities. Market value shows how the stock is valued now in the markets. What is the price that is prevailing in the market now in comparison to the price that was at the time of its beginning, its initiation, its registration, its listing. Return on equity. Return on equity shows how much return is available for the equity shareholders after deducting all the expenses of the company. Return on capital employed shows how much return is available or how much the company is earning over its total capital, and that capital comprises of equity and debt. So it is a better percentage analysis over ROE. Okay. Debt shows how much the loan company has taken. CAGR, compounded annual growth rate. It shows the compounded growth that the company has performed over its last years. Okay, it's the important basis for the companies to perform and for us to analyze the performance of a company for future also. On technicals, we have charts where we can see the company's chart, how it is going up or down. Okay. Candlestick helps us to show the price movement. It shows the high, low, open, close. Okay. Support and resistance, it shows how much price the company has went and how much the price the company used to take the support and again go up, again come down. Moving averages shows how the company is performing over the past 20 days, 50 days, 100 days, 200 days. Okay. Pivot point shows the prices that can be a support and resistance for a share to move. And we have so many other indicators that help us to analyze how a company share price can be predicted. So there is a lot of more discussions and an advanced version that can be availed only by registering in our upcoming video lectures, our stock market basic to advanced course that will be launched soon, and you will be intimated. So all these things you should know before you invest. Your fundamental analysis, your technical analysis. Okay. So this I am given just an example how a balance sheet of a company look like. See, in columns you can see the March 2020, 2019, 18 years, and in left hand side you can see equities and liabilities comprises of share capital, reserves, current liabilities, other liabilities, and the assets. So here we can understand the comparison how the company has performed from 2016 to 2017, 18, 19, 20. Okay, you can see the company performance. This is an income statement of a company that shows its sales, its other income, its expenditures, its total earning before interest, its interest that is paid to the on behalf of the debt we have taken, and the taxes paid to the government, and the net profit on the basis of which the earning per share is calculated. Okay, so income statement also shows how the company has performed and compared with past years. This is a chart, and this red green bars are called as candlesticks. Okay, so you can see in a candle it has some wicks, and that wicks at the up is known as high, lower wick is known as low, and the body has open and close. Okay, so this is a basic view, and there's some lines you can see. This can be a support and resistance, VWAP, indicators, moving averages, so many things are there. So after knowing all this, what mistakes you can avoid? Don't invest blindly. This is the success mantras that you should keep in mind before you should invest. You cannot blind invest. You have to understand the market, how it works, then only you should invest. Have patience, buddy. You can't be overnight rich. So when you are investing, invest with a good faith on the company, its future plans and expansion. Understand the company and then invest. Be regular. Invest in small parts. Be diversified. Invest in different sectors so you can get the benefit from all different sectors. Book profit consistently. Avoid tips because so many tips are available. Anybody can say, oh, this share is performing best, you can take it, and if you take it and next it will fall, that person is not going to pay you. It's your money. You have to analyze before listening to anybody else. Avoid excessive trading and maintain work-life balances. So you don't need to sit all the time in your laptop, your iPad, in your mobile, viewing the market, what is going down there. Do a proper trading in a proper time. Okay, and maintain work-life balance. See, at the end, your family important. Okay, because you are earning for them. So maintain a work-life balance and get the best out of this market with your skill, with your knowledge, with your analysis. So guys, thank you for listening till here. Hope you have enjoyed and learned something new. Thank you. Happy trading.